Today began with a thunderous global market drop as investors woke up to a $200 billion wipeout across crypto, equities, oil, and metals. Panic spread fast as major exchanges halted withdrawals, igniting fear among retail and institutional traders. Portfolios that seemed diversified just hours ago are scrambled. Order books became thin, liquidity evaporated, and the word volatility took on new meaning. This is the moment that separates traders from investors. An opportunity hides behind chaos. Crypto markets were first hit, with Bitcoin plunging more than 10% and Ethereum dropping nearly 12% within hours. Altcoins fared even worse, with Solana and Avalanche sinking over 20%. Liquidations on leveraged positions surpassed $4 billion, more than double what we saw in previous crashes. This isn't typical crypto volatility. It's a capitulation. But during capitulation, smart capital accumulates, and that's where advantages emerge. The equity markets followed suit. S&P 500 sank 5% intraday, Nasdaq lost 6%, and Dow dropped over 800 points. Tech giants like Apple and Tesla were hardest hit, dragging sectors lower. But consumer staples and utilities held up, drawing flight-to-safety flows. The coordinated drop across global indices shows correlation risk at its peak. This isn't sector-specific, it's systemic fear.
Oil prices suffered a massive drop after weaker-than-expected demand data from Asia was released just this morning. Brent fell 8% and WTI nearly 9%, fueling volatility across energy stocks. This collapse set off margin calls for many commodity-linked funds. Traders scrambled, shifting into safe havens like gold, which surged 4%. In a single day, we saw capital move from resources at record speed. Treasury yields spiked as bond investors dumped riskier assets. The 10-year yield jumped from 3.9% to 4.2%, a huge move in fixed income. This spike shocked mortgage markets, impacting both homeowners and real estate investors. Rate-sensitive sectors took the brunt. REITs and construction stocks collapsed. When bond yields break key levels, it signals broader financial stress, and today crossed that line. Retail investors felt the crash firsthand. Robinhood users reported delays in trades and massive margin calls. Many accounts were liquidated automatically, wiping out hard-earned gains. Social media platforms are flooded with pleas from users seeking advice on whether to hold, sell, or buy. Panic breeds emotion, and emotion can destroy capital. Savvy traders recognize that under every panic lies an entry point. Institutions were not immune. Hedge funds triggered circuit breakers after realizing their risk models didn't account for simultaneous drops across asset classes. A well-known macro fund reportedly suffered a 20% intraday loss before halting trading. Portfolio diversification failed when bonds, stocks, and crypto sank together. This event challenges conventional risk frameworks, forcing investors to rethink capital allocation. Central banks stepped into the fray. The ECB released a statement pledging to purchase emergency assets, while the Fed hinted at potential liquidity support. But these interventions may come too late. Markets already priced in panic, and once fear sets in, confidence lags. The question isn't if they'll help, it's whether they can restore trust fast enough. It's a race against time. In Asia, the Hang Seng and Nikkei indices collapsed amid this global sputter. Japan's central bank announced an unscheduled meeting as the yen weakened sharply. China's Shenzhen market dropped 7% after volume surged in panic selling. Investors feared contagion, even as Beijing has limited exposure. No region is immune when global capital sputters, and that's today's headline. Crypto infrastructure is under strain. Major exchanges like Binance and Coinbase saw order book depths thin to alarming levels, and some even paused altcoin withdrawals momentarily. On-chain activity spiked, with millions of dollars worth of stablecoins moved to centralized wallets. Data shows large addresses reducing exposure, moving assets ahead of potential further stress. Exchanges reporting unexpected downtime only heightens unease.
Corporate balance sheets are being tested under this stress. Companies like Airbnb and Uber saw their credit spreads blow out, signaling bond market skepticism. Real-time risk premiums jumped, and some high-yield debt traded below par. This capital flight into higher quality assets may signal a deeper credit cycle issue. When everyday tech names bleed, consider where real systemic risk lies. Commodity-linked currencies suffered. The Australian dollar dropped 3%, and the Norwegian krone tumbled as oil collapsed. Inflation hedges are now being rethought. Currencies tied to resources are vulnerable, exposing risks across emerging economies. ETF traders are reporting stop-loss triggers on forex pairs. It's a reminder that currency risk accompanies every commodity move. Gold benefited from the collapse as traders sought refuge. Prices spiked near $2,500 an ounce as physical demand surged in Asia. Buyers in Turkey and India were noted moving bars and coins, signaling grassroots accumulation. Central banks in Eastern Europe reportedly placed small orders for bullion. Amid it all, gold's role as a storm anchor reaffirmed. In contrast, crypto miners reported increased hash rates despite the crash. Large miners in Kazakhstan and Canada doubled capacity due to lower energy costs. Miners are building resiliency during dips, accumulating coins at bargain prices. It's a strategy that flips cost of production weaknesses into structural strength. Today's destruction may be tomorrow's foundation. The options market lit up. Implied volatility for Bitcoin and S&P options skyrocketed, with traders rushing into protective puts. Strike prices at deeper out-of-the-money levels surged in demand, forecasting bigger swings ahead. That pricing reflects fear that brings opportunity. Skillful hedgers thrive in volatility, while blind speculators retreat. U.S. consumer sentiment plunged, with confidence indices sliding to record lows. Mortgage applications cratered, and retail foot traffic declined measurably. The sell-off affected consumer-related stocks, fast food, travel, leisure, all down significantly. Once sentiment drops, consumption trails, and that's a recession red flag. We're watching for early signs today. On the equity side, a surprising outlier emerged. Defensive stocks rallied as expected, but rare names in biotech saw investor interest, likely a sign money is searching for uncorrelated alpha. Small biotech firms rose as safety plays, even as broader markets spiraled. This shift shows tactical allocation can outperform in chaos. Keep your eyes on sectors that hedge risk, not simply ride momentum. Tech earnings forecasts were slashed as CEO guidance turned cautious. Cloud names trimmed growth projections. Chip makers dialed back fab investments. Extensions of AI initiatives.
Geopolitical tremors intensified as conflicts in the Red Sea threatened shipping lanes, sending panic into energy and transportation stocks. Defense contractors soared on safe haven bets. Maritime insurers raised premium forecasts overnight. The risk landscape just fractured again and meaningfully impacted supply chains. Here and now, markets are at a crossroads. Fear dominates, but every crisis breeds opportunity. Your next move will define your future returns. Staying informed is non-negotiable. Be agile, hedge smart, identify unloved assets ready to rebound, and pivot quickly when the market recalibrates.